Let's talk to Mike van Dulken. He's the head of research at Accendo Markets. Very good morning to you, Mike. Right, we've got three good-looking charts to run through. Let's kick off with the FTSE 100. I've got to say that I wouldn't fancy being trading the FTSE for a living at the moment. Nevertheless, what are the technicals telling you?
Well, this morning we got a breakout above 7160, which was a bit of support, then turned resistance over the last few days. So it's good to see it back above that level. The bulls might prefer to see it actually above the 7,200 mark for it to be a good round number.
Right.
Potential for a run back to 7.3, although I do have reservations about whether it might be checked by that resistance from the early Feb rebound, which could send it ultimately lower. At the end of the day, we're still below longer-term falling highs from January's peak, and we're still, kind of underperforming year to date.
So what's actually driving the FTSE at the moment? Is it a lot of companies reporting, or do you think it's political?
I think company results is a big thing. We come through, very busy season as per usual, and then the overhang of Brexit. What is it? Yesterday, Theresa May says made huge progress. A, what is Brexit? B, what is the transition? What is the agreement? They're three very different things at the moment. So until we get to know that, there's a difficulty. And I did see talk of global funds shunning the UK until we get clarity on that.
Right.
That said, a huge amount of the UK is a huge amount of the FTSE rather is
overseas,
UK listed, but it's international exposure, so they still benefit from the general economic recovery around the world. So in a sense, there it's kind of a haven. But in the other sense, there is the exposure that does have a cloud above it for the moment. So, as I said, I've got reservations about whether we can get through 7.3, and even if we do, there's resistance lurking just 100 points higher. So, as you say, not an easy one to trade of late. That said, it has offered some interesting ranges, and getting above a level like 7160 this morning, even if it only offers 50 points, if you're more certain of that, is quite handy to have on a daily basis.
Yep, understood. Okay, well, let's move on to the next chart. Just Eat PLC, obviously in the FTSE 100 now. First time they were reporting as a FTSE company.
Yep.
I've never understood this business model. I'll put my hands up on that, but nevertheless, shares have been onward and upward.
They have. Decent trend all the way since early 2016. A nice solid uptrend. Recently it topped out at what we had identified as rising highs resistance. At the same time, we've had rising lows support, which has been tested this morning on the report. Revenues are up 45%, good number. EBITDA up 42%. It's a good number, but it implies margin contraction.
Right.
Secondly, the guidance they've given was well below what consensus was looking for. They were looking at 165 to 185 million underlying EBITDA. Consensus was looking for something well north of 200. And they're planning on spending a lot more money in 2018 as they integrate the Hungry Horse acquisition and they continue to expand and take market share. So, again, it's not as simple as perhaps investors were assuming it was. There's been a repricing this morning, but I do wonder whether it's going to be able to hang on to those rising lows. I know it's tested below, but if it can close above them, technically you could just bring that trend line a shade lower and keep the uptrend alive.
Yep.
If anything, it could offer a bounce opportunity. The shares were 12% at the worst this morning. There could be a bounce opportunity back towards 900 if it's seen as an overreaction.
Well, again, if you run a tight stop there, you're going to be, the risk reward is probably
potentially very
the right thing to do.
Indeed.
Okay, well, let's move on to Lloyds Bank PLC, a bellwether for the UK economy, I always think. Pays a half decent dividend.
And the UK housing market.
And the UK housing market, yep.
Biggest mortgage book. I think a nice, attractive bounce there, albeit only day two of the bounce. But yesterday we saw those rising lows hold up around the 66.5 pence level. Potential upside to 70, which has been a key level going well back, actually, well beyond this chart.
But that's a messy chart, though, Mike, isn't it?
It's not the prettiest, I'll grant you that. But even if you put in even more trend lines, across the falling highs from January's peak, there's still a range to be traded between 67 and 70, which doesn't sound like a huge amount, but on a 67p stock,
it's a 20% swing.
It's not to be sneezed at. As you mentioned before the show, it's now sitting on a dividend yield of 4 or 5%, which is a far cry from the zero it had for many years. So it is attracting the income seekers back in. It is a cleaner bank. It is more UK exposed. It doesn't have the international headwinds that some of the other banks are showing, or indeed, in some cases, that is the attractive nature of maybe the likes of Barclays and HSBC and Standard Chartered. But I think this is a simpler operation for many investors to get their heads around.
Well, there's no investment banking anymore, is there?
Indeed. Cleaner,
So,
that's what got most of the banks into trouble a decade ago. It's a simpler operation now, and I think that's why it is, again, not the prettiest of charts, but it's it's not swinging around quite as crazily as it did in the years gone by.
On that note, Mike, thank you very much.
Thank you.